Welcome to PhillipCapital's Weekly Market Watch. My name is Lynette, and I'm an investment analyst with Phillip Futures. Equity markets have seen some turbulence lately, prompted by uncertainties in global economic growth and inflation. In contrast, agricultural commodities have been a relative haven, with futures prices on the major exchanges affected to a lesser extent. Many studies have shown that prices of grains seem to have little long-term correlation with interest rates and the global economic cycle. Factors such as population growth, changes in worldwide standards of living, and production numbers are the main key movers of grain prices instead. Grains can provide a natural hedge against inflation. The current low interest rates and quantitative easing in developed economies, combined with inflationary pressures in rapidly developing economies like China, means there is a growing risk of an inflation upsurge. Already, we see that food-led inflation has been a key concern in many Asian countries such as China, Vietnam, and India in the last few months. This may encourage investors to buy assets which provide a natural inflation hedge, including agricultural and grain futures. One key product, corn, seems to be the favorite of commodity analysts for this year. Corn prices have continued its upward ascent despite volatile markets. Corn prices have risen 223% in the last 5 years, hitting an all-time high of $7.99 a bushel in June this year. At Phillip Futures, a mid-year outlook on corn prices forecasts a long-term uptrend for CBOT corn and estimates that it could trade up to a record high of $8 a bushel. In the US, the pace of corn planting has been well behind the average so far in 2011 due to unfavorable weather conditions. This Monday's weekly crop progress report by the USDA showed greater than expected crop deterioration, causing the CBOT December corn to set a contract high of $7.48 on Wednesday. National yields could hold below USDA's 153 bushel yield estimates, which would ensure supplies remain uncomfortably tight for the rest of this year. CBOT corn closed higher on Thursday at $743.50. The MACD and signal lines are both above the zero level, which signals a bullish trend. The chart also shows corn trading near the top band of the 20-period Bollinger, and the 14-period Relative Strength Index is also near the 70 levels, which signal oversold levels. This could mean that we could see some slight correction in the short term. On top of this, Federal Reserve Chairman Ben Bernanke's Jackson Hole speech later tonight could put grain traders on the sidelines in order not to be caught in volatile markets. With the uncertainties in the global equity markets, the corn market is no exception and may be vulnerable to short but brief breaks as investor sentiments overtake fundamentals. Nonetheless, we expect prices to move higher later next week on expected crop concerns if the macro concerns stabilize briefly. Any influx of capital from shaky equity and debt markets is likely to support grain prices further. Thank you for watching, and tune in to PhillipCapital's Weekly Market Watch next week.